Welcome to the show. I'm Andy Hagans, and today we're going to dive into all sorts of alternative asset classes. Today, I'm speaking with Saira Rahman, who is VP of New Investor Initiatives at Fundrise. And Saira, I have to say, Fundrise is a huge name in this space, especially in terms of democratizing alternatives. So I'm really excited to have you on the show. Welcome.
Thank you so much. I'm so excited to be chatting with you today.
And I have to think that most folks, most listeners, viewers in our audience are already familiar with Fundrise. I mean, I do think I hate to say, you're almost a consumer brand, which is that's like a unicorn, actually. Now that I think about it, I'm processing this in real time. The alternative space, we're the alternative investment podcast. There's so much in here. It's not exactly B2B, but it's kind of more sophisticated, very niche. There's just a couple brands in this space that are truly B2C. I have to think that Fundrise is one of those. Do you agree?
Absolutely. I think I'm probably bragging a little bit here, but I like to think we were the first one. So we came out of the Jobs Act in 2012. And we were really that first real estate investment platform and have since expanded into the entire alternative universe and are gradually expanding into more and more product lines. But yeah, that dream of democratizing alternative assets for retail investors is definitely our North Star.
It's funny, Saira, I have to say, the democratizing access to alternatives, I think like 1,000 companies have that as their tagline or in their mission statement or something. But a few companies I feel like actually have made huge headway in that, in different ways, right? Like in iCapital or Case, those kind of plumbing of these networks where products are sold through advisors. And then platforms like Fundrise actually bringing them, truly mass market. Now, I'm familiar with Fundrise, but it's probably been a while since I've been on your website. I saw that you now have 1.8 million active users, according to what I read, and 387,000 investors on the platform. Are those numbers accurate?
They absolutely are. And I mean, we're growing every day. And we started with real estate. We've since expanded. We also have venture capital that we launched last year, which has a bunch of different interesting facets underneath it. And then we are in the midst of launching a few more.
Okay. And look, take us back. You said Fundrise was the first, not to brag. And I'm not fact checking, but that sounds plausible to me because there's a reason that you guys have such a big name. You mean in terms of a crowdfunding platform that's offering alternatives to non-accredited investors, or what were you the first at, I guess is what I'm asking.
Yeah, we originally started as crowdfunding for real estate investments. So our first few transactions were individual buildings that you could invest directly into, that our co-founders raised among people that they knew were as passionate as they were about real estate. And then we've slowly shifted over time. We eventually launched E-REITs in the early to mid 2010s era. And then in the last 3 to 4 years, we've launched 2 40 Act funds. So our flagship fund, which is a standard 40 Act fund, and then most recently our venture fund, which is also another 40 Act fund that we offer.
Got it. So you now have a mix of products that are crowdfunded or not crowdfunded, and sort of something for everybody. Is that accurate? Or I guess could you walk us through, who are the typical in 2023 investors who are signing up at Fundrise every day? What does that mix of investors look like?
Yeah, that's actually one of the more fun parts of my job right now, is doing the research on our underlying user base. And what we've come to find is that the typical investor on our platform is a high net worth investor who has additional funds and wants to have a real estate portfolio, but doesn't desire, or realistically any of the alts that we offer. So also in the innovation side, on the innovation fund, I should say. But between those two, they want to have alternative assets in their portfolio. They don't necessarily want to own a piece of real estate. They don't necessarily want to go dive in and offer, $50,000, $100,000, $150,000 checks to be an LP to a name, or maybe they don't even have access to those things because they don't know who they would go to. So then they turn to us and they give us those funds and they entrust us to invest on their behalf. So we have a series of non-traded REITs that you can invest in if you like real estate. We also have our innovation fund if you wanted to invest in venture capital.
Got it. So it's not necessarily that your users, that your investors are non-accredited, that they may be accredited investors, but they're either looking for, that direct platform or maybe smaller ticket size investments, or something like that. Is that accurate?
That's exactly it. So you can invest for as little as $10, but our average investment size is usually quite a bit more than that.
Got it. Okay. And you're still doing the crowdfunding thing though, right? So if someone is non-accredited, they can still sign up on Fundrise and they can still plunk down their $10?
Absolutely. We welcome everyone.
Got it. Yeah, that honestly, that's what I mean when I say every company claims that they're democratizing access to alts. It's actually pretty rare that, a company has that offering for everyone. So, well, let's start with real estate. I have to say it's a favorite asset class on this program. Obviously, at Fundrise, it was your very first asset class. Take us through that evolution. You started with these individual properties, individual assets, and crowdfunding those, and then into non-traded REITs. Are you still doing individual assets, or is it kind of grown beyond that to these funds? What's available now in 2023?
So we have a bunch of different strategies that you can invest in. So we take the approach, in my opinion, that's very much like a mutual fund, but obviously not in the equities or publicly traded world. So you can select a strategy. We also have Fundrise Pro, which is where you can individually select one of our REITs, which is our subscription model. But between the two of those, you can choose essentially a strategy that you really believe in, whether you are really into East Coast developments or whether you really want to just have a little bit of your money across all of our different REITs. We have an income fund as well as like our typical flagship, which is a little bit more on the growth strategy side. And then obviously, if you wanted to get into venture, which I guess is separate from the real estate piece, we have a separate strategy for that. But we don't currently have individual property investment. We found that most of our investors tend to prefer that we allocate on their behalf in a very similar strategic manner to how we would want to allocate our own portfolio.
Got it. Okay. So you're saying most investors coming in, they're looking for that blend anyway. They're looking for diversification. So
yes,
you have to give the people what they want, right? That's rule number one when raising capital. Is the real estate market, from my standpoint, it's not frozen. There are still deals happening. There are still investors, writing checks, but it's in this sort of holding pattern. It feels to me, where everything is just slowed down, not quite frozen, but slow, a little bit more glacial, maybe. Is that what you're seeing on your platform? Is interest slowed down or have deals slowed down?
I mean, it's it's interesting that you asked that. I think from a real estate deals perspective, it's certainly slowed down. We are picky to begin with the deals that we want to bring to our platform because we do compete with all the other major institutions in terms of searching for the right deals for our REITs. I think the complication within that is that people have less disposable income, they have less investable income, particularly in the retail realm. So has it slowed down? A little bit. The nice thing is that from a strategy perspective, a lot of people consider particularly alts to be uncorrelated to the market. So if anything, as seen a lot more of my friends actually asking me what I do now versus before, where alts probably were kind of this side the sideshow to public equities. So that's been probably the biggest shift that I've personally noticed over the last 6 months or so.
Yeah, I've seen a lot of research talking about Gen Y, Gen Z. They don't trust the stock market. I mean, I know that's kind of a big, bold statement. It doesn't cover every single person, but compared to like the baby boomer generation, they're way more open to all kinds of alternative investments, including crypto, which doesn't always end well. Nothing against crypto. I own some Bitcoin, but all types of alternative, like Gen Z might view crypto as just as a legitimate type of investment as the stock market, right? Which that's really a shift in alternatives' favor, right? Because it's no longer, as you said, it's no longer this little thing over here. Do you interact with any users who are, using Fundrise as like their main investment vehicle, not as a 20% thing, but they're like, you know what? I want to start investing. I don't like the stock market though. I heard about this Fundrise. I'm going to get on Fundrise and actually start with this.
Probably the most interesting thing that I noticed, particularly after you see a lot of the articles that came out between endowments and Blackstone doing research on the 60-40 portfolio and how that's really not something in modern times that a lot of people are actually following anymore. And there was this huge shift of, especially even within our user base, I would say, where it's like, it's no longer this 5 to 10% allocation, right? You look at the high net worth individuals, the ultra high net worth individuals, the endowments, and the allocators that are going anywhere from 20 to 50% into alts. And suddenly you start seeing large jumps, whether it's with fundraisers or even with some of my friends, people that I've been talking to outside of work who are much more interested in heavily investing in alternatives, because that's historically, at least for the last decade or so, where the vast majority of the alpha is being found, particularly with private markets such as real estate, such as venture.
So they're just way more open to it. And I kind of agree with you on the hook. I'm a marketing guy. I'm into finance, but I'm into marketing. The show is kind of the intersection of those things. And to me, that's one of the biggest hooks. And I think even if you listen to our audio trailer on like iTunes, the first line, I forget the exact quote, but I say something like, how do billionaires really invest their money? But to your point, this is something that the Harvard Endowment, the Yale Endowment, institutional investors, they've been investing in alternatives for years, and it hasn't been this 10% allocation, right? It's been a substantial, almost a centerpiece in many cases of their strategy.
Exactly. And that's something that I have really started preaching. I think from a financial literacy standpoint, accessibility is the key. And it's not just the accessibility of like, okay, I can invest in Fundrise. It's also how are you presenting the information to the people that want to understand it, and is it in a digestible format, and are you doing it in such a way that they feel comfortable investing in that alternative investment, which I really think is a differentiator on our platform.
So what does that mean exactly? Just that, like the user experience, that when I get on Fundrise, I don't need, I would like to think if you've been listening to this podcast since the beginning, we're on like episode 150 now, you're going to be very well versed in all kinds of alternatives, all these asset classes, all these terms, but a lot of people aren't, right? A lot of accredited investors. My business partner, Jimmy, talks about this all the time. He's like, my next door neighbor is an accredited investor. He does not know that he's an accredited investor, but he's an accredited investor. So a lot of these terms that we use, like accredited investor, GP, LP, even like private credit, just like, users don't understand them. So is that a big part of your secret sauce? Just making the user experience very, I don't want to say dummy proof. That's the wrong word, but making it
educational. We're making it very educational. It's like, I consider myself to be part of this group. I mean, I spent a very long time selling complex financial instruments, but in terms of understanding, even the nuance behind accredited investor, understanding exactly how a real estate deal works. What is a cap rate? How do large entities go out and pick out their properties? What do they look like? How do they price them? What does angel investing actually mean? Am I just writing checks into random companies? Who are these companies? How do they get vetted? How do you price them? How do you understand the private markets versus the public markets? What are the differences between those two? I've been fortunate to experience a lot of those things now that I joined Fundrise, but I don't think for the average investor, particularly those that are, call them millennials, maybe even some of Gen Y, and most certainly the vast majority of Gen Z, as they start to accelerate in their careers and make more and more money, there's this huge gap in literacy in terms of understanding what exactly they're doing. And then the flip side of the coin is there's also these extremely educated individuals who are like, you know what? I just want to trust somebody else with my money, that it comes from an institutional background and I can throw a bunch of cash at them and not have to worry about it down the road. And they just want to passively invest and have it be done at a very low fee relative to what the market actually sits at, which is probably the other small secret that we kind of keep in our back pocket.
Well, I totally agree about the education gap, but to me, I might take it a step further and say it's not even a gap between generations, because most baby boomers, I mean, heck, even most financial advisors, there's not enough time to really be an expert, in each of these asset classes. I mean, to me, that's the beauty of alternative investments, but it's also kind of a problem. I can say this from firsthand experience, hosting this show, the Alternative Investment Podcast. I'm like, this world is almost like everything. It's like it's the entire earth, everything you can invest in, which is a heck of a lot of very different things, minus publicly traded stocks, minus publicly traded bonds, minus cash. It's everything else. And so it's like if I'm an advisor, like you expect me to be an expert in private credit and angel and venture and now baseball cards or limited edition sneakers. So I totally respect. And I think even from that business perspective, I understand the decision to put education at the front and sort of, almost have that be your marketing. I guess, do you all look at education almost as a form of marketing?
Absolutely. I can speak from having observed just almost, I don't know how many at this point, actually, pieces of our writing that goes out. It's the co-founders come together, they write it. It gets touched by 6 other people, but it's still their brains. It's still them talking. It's still their voice. And I think it's just so incredible how well-versed they are on the subject matter, that they're able to simplify it and turn it into something both digestible and interesting to read. And it's honestly what drew me into the platform when I started interviewing to join, because that level of mastery of subject is just incredibly rare across the industry, unless you have just the massive depth of knowledge that the people at Fundrise have.
And then communicating it is like a whole separate thing, because a lot of times, there's people who know they might be geniuses at something, but breaking it down, communicating it clearly so that, everybody can understand it, that's actually really hard. And so I guess that brings me to, I wanted to talk about some of these other asset classes on the Fundrise platform. One thing that I respect is, given how long you've been around, and it sounds like your co-founders are still very heavily involved in the day-to-day stuff. You're not trying to cover every asset class, you don't have 20 different asset classes on Fundrise. You have 3 or 4 or 5. And to me, that kind of speaks to, we want to have this depth of experience if we're going to, have a product in a particular asset class, right?
Absolutely. I mean, I will say the reason that I was hired was to help figure out what some of those new asset classes and fintech adjacent products will be down the road. But that being said, we know what we're good at, and we vertically integrated / built down value chain on the ones that we have felt very passionate about.
Mm-hmm.
So those have already been constructed, and we're certainly contemplating what the next version of that should be.
So we started with real estate, and then we moved on to venture capital. Let's go to venture capital next. So does Fundrise have a fund that invests in seed rounds? Is a Series A? Do you have your own Fundrise branded VC fund?
Yes. So we call it the Innovation Fund. It's a 40X fund. It's a fund that is designed for founders. So it's if you were a company that started, or you were a person that started your own company, this is exactly what we envision you would want invested in your company. I guess it's twofold. The first piece coming from our extremely engaged investor base, which we can leverage through the investment. So our investment strategy provides updates to our investor base, which you mentioned the numbers on earlier. And that investor base is both highly engaged, and at least a quarter of them are in the tech and startup world. So there's a little bit of, network effect is probably dramatic, but it's a very interesting way of being able to get more brand awareness and hopefully some lead demand on your product, rather than having to just send it to 100 high net worth investors or an endowment where there's not as many eyeballs that get to see what your investment is. We work with the companies to position them. And then in terms of comparing ourselves to a traditional fund, we're also growing exponentially. So that investor base is perpetually growing every single day, and we're exposing every single one of them to the investments in the venture fund in hopes of helping them continue to be able to grow as a company. Trying to think what the other things that are significant would be. I guess the other big one is that we're passive by design. So we intentionally created an investment vehicle and structural infrastructure of the actual fund that makes it such that we don't have a board seat. We're happy to be board observers. We're happy to provide advice. We're certainly investing in things that we're passionate about, but we don't actually intend on taking any control over any of the companies that we invest in. So those are probably the biggest value propositions and differentiators within our fund.
So then you guys get like a free ride off the other GPs who are, I'm kidding. But no, I kind of get it. It makes sense with 387,000 investors on your platform. Just that sheer number of social connections or relationships, I would think that would bring, you said, I think you said branding or mind share, whatever word you use, but also potentially a deal flow or just that trust of being a brand name. You're not Sequoia, but really there's only one Sequoia, right? So after those first few big names in venture capital, gets very fragmented very quickly, right?
Absolutely. And you say Sequoia, our first investment was in this incredible company called Vanta, and they're a data compliance entity. And if you look at Sequoia's website, Vanta is actually spotlighted as one of their favorite companies. And it just speaks to the fact that we're able to bring investors in for as little as $10 to our platform to offer that innovation fund. And we're investing alongside these behemoth venture investors such as Sequoia. So it's one of those things where the value proposition is enormous if you can understand exactly how that works.
Got it. Well, sticking with VC or sort of, I wanted to ask about secondaries. So tell us about this asset class and how Fundrise is offering access to secondaries. This is obviously something different than the Innovation Fund.
Yes. So there's this cross-pollination between our Innovation Fund and then we have this other product called Equitize. And Equitize is offering the ability for the C-suite of any startup to essentially come and have control over liquidity on their secondary shares. So in contrast to companies that will have, ROFR or no ROFR in terms of optionality. We actually give full control to the C-suite in terms of, okay, let's negotiate what the share price is, and then you can determine based on your employee's tenure and based on how much you want to offer in terms of liquidity, what that looks like structurally on your cap table. The benefit to the company is that they only have one entity sitting on their cap table. So they're only facing Fundrise, which is, obviously significantly easier than the complex cap tables that end up coming out through some of the other companies that provide liquidity. So we've flowed, I believe, $1 million so far through Equitize, but it's rapidly growing. My understanding is that there's several transactions that are occurring in the next couple of weeks, but it's our newest product and probably the one that I'm most excited about for founders.
There's so much growth in that space, and I would say it's overdue, really to give founders and employees this kind of access to the secondary market. Is your product, is it only supporting companies in your venture capital fund, or is it open to other VC funded startups as well?
So we're open to really any company that wants to come to our platform. We do have some parameters. So we're for both, and essentially the thesis ties out to both of them. So it's data, infrastructure, fintech, prop tech, B2B enterprise that kind of sits within our thesis in terms of the overarching themes. We're looking at growth stage, and we're hoping for more than 50 million raised so far. And average age is probably greater than 5 years. But generally speaking, we're open to talking to any company, even if they're in the earlier stages, particularly because we want to track them. We want to give them advice if they fit within our thesis and get them to where we can make the investment.
Got it. So I've had, several GPs on the show before in venture funds. I haven't had one on the show too lately. I'm guessing valuations are still pretty, I'm going to say attractive, as an LP, as an investor. Are valuations in the innovation fund and the secondaries, are they still very, very attractive for investors, favorable for investors?
Yes. And that is definitely something that we're thinking about before we make the investment. One of the things we have noted is, current valuations are at about 50% of what the last valuation probably was, which is okay. And it's better for our investors, and it's probably closer to reality than not at this point. But yes, I would say the discount is still ongoing.
So sorry, so 50% of what it was, or maybe what it would have been. Are there companies raising money in down rounds? Is that the norm, or you just mean that the typical valuation multiplier now is much less than it would have been like 2 years ago?
Yeah, I am speaking from conversations that I've had in the last couple of weeks between LA Tech Week and some venture meetings that I've been attending. The general consensus is that they're at about 50% of what they probably would have been. And there are some down rounds that are happening there for sure. Those are spoken about less, I think, but they're common to, I believe they were called like pull-through rounds last time we had a huge venture recession. So similarly priced.
Yeah, it's to be honest, the valuations of 2 and 3 years ago were probably just too high. So I don't know, it's kind of like when when stocks go down, I think it's Warren Buffett is like, you should love that. It's like stocks are on sale. You go to the supermarket, if groceries are on sale, it's a good thing, right? But at the same time with venture, I do think it was probably overpriced. And now I think, Saira, I might agree with you. Maybe now it's just more realistically priced. But still, it has to be said, real estate hasn't had a 50% valuation reset, right? Like I feel like depending on the sector, geography, you're lucky to have a 10% or 15% or 20% discount to 2 years ago. So 50% just seems very attractive, and just that's a big, bold number for invest. Do you like venture, kind of switching to, investor to investor? Do you like venture capital right now in 2023 at this point in time?
I do. I mean, the IPO window is still closed. Companies are staying private for longer. You're seeing it across. I mean, I think coming from a fintech background, I mean, you're seeing it with Stripe, you're seeing it with Plaid. There are just so many companies that are incredible that are staying private for longer. So it is, and historically, over the course of the last decade, it's just outperformed time and time again against every other asset class. So I'm still very bullish on the space. And I know it's been a tough year for companies that are fundraising, maybe 2 years now, I guess. But it's still a great place to be investing. And I'm very bullish on the long-term prospect.
Yeah, as long as you can diversify. That's my thing with angel, with venture, returns are high. As long as you're able to diversify. But I know we don't have a ton of time left, but I wanted to ask about one more asset class. I think this one is going to be really in your wheelhouse, given your professional background. So Fundrise has a private credit product. Is that right?
Yes, we launched that. I can't recall if it was in December or if it started earlier this year, but we launched a private credit fund, and it is an accredited only. It's one of our only accredited only products. But given the market dislocation, the inverted yield curve, and I mean, I would assume that you guys, based on some of the podcasts I've listened to from the show, you guys have definitely touched on interest rates and private credit already. So strategically, it just made perfect sense given our position. So we launched that, I believe, earlier this year, and it's been wildly successful so far. But we are specializing in that for at least, I believe we'll have more windows open later this year. But it's currently waitlisted, but we are periodically opening the window to allow additional investors in on, I believe, a monthly basis.
Oh, it's waitlisted. Holy, I know we have some sponsors and platforms who listen to the show. I think a lot of folks might be jealous to hear, well, we're raising capital, but it's closed right now. We have a but I will say with private credit, it was one of those asset classes you always heard about. It's kind of quiet. Really, in the past, I'd say 9 months, I've heard private credit more than like in the previous, multiple years beforehand. It's just a lot more, even like family offices, even more sophisticated investors, ultra high net worth, who might have, they knew what private credit was, but they never really invested in it. And now they're allocating to it, right? Interest rates are higher. And then also the spread then between private credit and bonds is also higher. So you add those two things up. I think a lot of investors are saying, well, shoot, if I can get 9-10% and not have to take on the risk of like equity in real estate, I'm just going to invest in this private credit fund. When you all decided to launch in that space, was it mostly just investment thesis? Was it demand from your existing, were people like asking about it? Like, when are you going to launch was it a combination of those things?
Yeah, I mean, this speaks to like the brainiacs that are in our C-suite, but they really wanted to have higher risk-adjusted returns in a recession-resilient sector. So we focus on mezz and senior preferred in the multifamily sector, and when we started having the conversations to just kind of litmus test to see what the interest level was, it was explosive. So it's one of those things where we would love to take on more funding. It's just very hard to do when you want to do it well and do right by your investors. So we're gradually ramping that up over the next few months.
Yeah, if I'm reading between the lines, you don't want to do deals just because you could raise capital and do deals. You don't want to do it just because you could. You want to make sure that it fits your underwriting criteria. As an investor, as an LP, I respect that very much. Well, Saira, I know you used to do interest rate derivative sales. We're talking about this a little bit before we started recording. We're talking about private credit. I'm going to ask you to do a very dangerous thing. I want you to reach or turn around, pick up your crystal ball and tell us as investors, where is this going? Obviously we have this kind of hawkish pause or whatever they're calling it. Are interest rates eventually going to come back down, or can I expect this higher interest rate environment for a good long while?
Humorously, that is why I have a crystal ball in my office. The running joke on my trade desk used to be that if we could predict interest rates, we'd make a lot more money. But I don't know, I think is my short-term answer. My short-term answer is, I think what we saw for the last, almost 2 decades, two decades plus maybe at this point, was just a different, or I guess less decade, technically 15 years, but it was just a different world. I entered in right as the market was crashing into the interest rates world. And I feel like it was a very different time. It was a very different market.
Mm-hmm.
I think every market is a new market. So, I could be completely wrong, but I see us coming back a little bit, because you can only, you kind of see things halting. I think we all sense that there's a recession coming. So, there's only so many things that the government can do to fix things, lowering interest rates being one of them. I just don't know that it's ever going to go as low as it was before. That being said, I have been wrong every single time I've ever predicted interest rates, even though I worked in it for 11 years. So,
well, thank you. Saira, I have to say thank you. You qualified it very, very well, but you're at least, for the record, I think I kind of agree. I just turned 40, and I've told people this, until a year ago, the idea that you would be buying any kind of a taxable bond fund and that you could actually make returns triple net, net of inflation, net of taxes, net of fees, didn't even occur to me. I'm like, bonds are this place in your portfolio where you're trying to barely maybe stay even with inflation, triple net, now with private credit, you have inflation, the CPI, the official CPI numbers at least falling, but with these private credit funds, it's like, wow, you could actually make some real return here, risk adjusted return. And part of the reason why I ask is even as an investor, or if you're an advisor, it's like, well, yeah, but do you even want to bother? Because if this fund is just going to be yielding 6% a year from now, do I even want to bother with all the paperwork and getting the K1 or what? But I think I'm with you that, it may give back, as inflation recedes, and it is receding, but it's not, inflation's not going to get back to 2%, or if it is, it might touch it and then come back up, because there have been structural changes, right, in the last couple of years. And like I mentioned, how old I am, you can go through multiple decades and have interest rates be in this range, and you kind of get used to thinking it's always going to be this way. And that's true until it isn't true, right?
Exactly. I struggle to see a world where we go back to 2009 and 2010. So,
well, I like it, because to me that means that private credit is maybe more here to stay, because you always have that, the additional buffer, that additional yield that private credit will be paying versus, high yield bonds. But it sure helps when that base interest rate is already high, and then that spread, you add that spread onto it. It just makes that asset class so much more attractive. And I think honestly, a lot of family offices, ultra high net worth investors, they knew what it was, but they really weren't invested in it. 2023 has really been the year for private credit, in my opinion. So not surprised. Fundrise, you guys always seem like you're, ahead of the curve. Not surprised that you have a product there. I know we're about out of time. Is there anything you guys have coming down the pipe that, and anything later this year that investors maybe should keep an eye on? Anything you're working on that you're excited about?
I do have one thing I'm excited about that I can't say a ton about, but we are bringing the wide world of private investment to allocators platforms, to different fintech companies, to brokerages down the road. So officially creating kind of those pipes. And I'm fortunate that I'm one of the people leading that project. So I'm very, very excited about that, although I can't talk a ton about it just yet. But that is going to be launched here in the near future. So be on the lookout for that as well.
Great. Well, Saira, when that is launching or about to launch, we'll have to have you back on the show to give us a sneak preview of that platform. In the meantime, where can our audience of high net worth investors and family offices go to learn more about Fundrise?
You can go to www.fundrise.com. That is our home website. And if you would like to get some referral through me, it's www.fundrise.com/Saira, Saira. But yeah, and feel free to come find me on socials. I'm always happy to chat. So
I'm going to make a note right now, Saira, to put in that referral code on our show notes, which are always available at wealthchannel.com. Saira, thanks again for joining the show today.
Thank you so much, Andy. It was great chatting with you.